Welcome to Nasdaq TradeTalks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, a regulatory landscape, and capital markets. This segment is presented by Charles Schwab. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq Market site, we have Max Cabasso, Senior Director on the Nasdaq Market Intelligence Desk, Michael Normyle, U.S. Economist at Nasdaq, and Austin Walker, founder of A. Walker & Company. We're here to discuss how real estate's role is evolving within private capital markets, along with housing, policy, affordability, and regulation. It's great to have all of you with us. Welcome to Trade Talks, Austin. It's great to have you with us on the show. A lot to unpack there. The housing, the housing market really does impact what we see in private, public, capital markets as well as how it's impacting, Americans who want affordability and to buy a home. Absolutely. So give us an overview of, how you're seeing the space right now. Yeah, I think it's been really an interesting couple of years, just re-emerging out of COVID. You're still dealing with a lot of kind of tail risks off the back of that, right? Rent inflation way up, home prices nationally up 50% plus since 2020. So you're really facing a lot of interesting challenges. And then obviously with this administration, things are changing every single day. So it's been a really unique cycle, certainly one from peak to trough, the longest it's probably been since '08. So it's been very challenging. We specifically focus on that intersection between, policy focused mostly on workforce and affordable housing. So we play in this every single day. So it's just been, really state by state, municipality to municipality, just real time on the ground changes and just being adaptable. But I think long term, generally bullish. It's, seeing 10-year kind of get bought up to, going below 4% for the first time in a year is a nice signal for us. And, just trying to work through how, tariff policy is going to continue to evolve the landscape, affect construction, immigration policy, all of these things just continue to be a little bit fluid. So we're, just, long-term bullish, but short-term intermediate, just being patient. Yeah. So certainly waiting for that clarity to come into balance here, Michael, because part of the challenges too is supply and demand, within the housing space as well. And we've spoken about this before on Trade Talks. Can a quarter, half a point really move the needle? And of course, it's contingent on what's happening with the 10-year. But you have many folks that are sub 4, sub 3.5%, sub 3% on their mortgages. There's not much incentive unless there's a have-to situation.
Yeah, I think there's, on average, the outstanding mortgage rate is a little above 4% right now, but it's currently way below where the market rate is, about 6.3% last I checked. So hard for people to give that up given the gap there, and hard for Fed rate cuts to make up that gap. So seems unlikely that rates are coming back down on 30-year fixed rate mortgages to 4% anytime soon, but they are going the right direction, right? The 6.3% is one of the lowest rates that we've seen going back to 2022 when the Fed started hiking rates. So there's been a little bit of relief provided there. If you look at refi activity, it's actually been picking up in the last few months here as rates have come down. So there are people who got in at higher rates that are starting to refinance to lower rates. But that middle ground of people that are sitting on their 3%, 3.5% rate, looking at a 6% rate, if they move, that's a tougher sell, I think.
Well, from a historical perspective, 6% is not a bad rate. So perhaps buyers and sellers need to readjust their expectations?
The challenge, for me, at least from my perspective, is that when we had 6% rates last time, homes were so much cheaper. Yeah. Yep. And when you're looking at a 50% increase in home values, like you mentioned, in 5 years, and mortgage rates are the highest they've been in 15 years. That's where the unaffordability aspect gets really challenging for people, and really challenging to solve as well.
Yeah, well, I mean, Max, there's really no benchmark for it, right? I mean, to see the increase in housing prices and then the historical lows of getting mortgage rates. I mean, it's just an anomaly that hopefully won't happen again. You don't want the rates that low because then you have a bigger problem.
Right. It's how do we get to that point where rates are at the point where people are comfortable getting rid of their, sub 3% mortgage? We talked about, all the time. You just mentioned it. Last time we had rates at this level, dating back, 30 years ago, home pricing was so much cheaper, and we haven't seen wages keep up to that same level, and also rent increases have gone up as well. So it's not like you're actually saving a ton of money by renting. That's been just as costly. So the ability to save up, to have that down payment or put down as much as you can to kind of offset some of that interest rate, expense is not really there, because we've had that large inflation over the past few years. Obviously, it's come down. We're in that 2.5–3% range. Still, after what we talked about previously, when you look at the cumulative rate, okay, we're at 3%, 4%, but when you look over a 2-year period and you're at 20–30% inflation, wages really haven't kept up with that across the board. Also, like you talked about, kind of depends on where you're looking, because we're seeing more supply, but where are you looking? And I also think a return to office, kind of a byproduct of return to office, is more of that concentration around where your work is. So obviously it's a lot of cities. So how am I going to get there? Now, 2 years ago, when you were really more hybrid, a day or two in the office, you might be more willing to have that longer commute for that 1 or 2 days. But as we kind of aim back towards that 3, 4, and even 5 in some places, that commute time factors in. So you're not going to be getting as far away out from the cities as you can, where you have land and there's availability of houses being built. So that kind of factors into it as well. So there might be additional supply in certain places, but it's not really where home buyers are looking to go if they are returning to their office and they're in a city where you're going to see the majority of jobs. So that factors in as well, not being able to match up the supply and demand. But like I said, the cost of pretty much everything, taxes are going up, everything is just getting more expensive. Food, everything is more expensive. So that cost associated with a 6% mortgage at these elevated rates, it's not going to work. And also existing home buyers that are in their house, they might not even have a mortgage, called boomer, the older generations. Are they going to go and sell their house that they have comfortable to downsize for something that's essentially the same price? Or they might need to, like we talked about earlier, you might have to fix it up and invest additional capital into it. They're not really incentivized to go out and do that. So for them, we're going to sit tight. I'm not going to drop my price. I don't have to do anything, so I'm just going to sit tight.
Yeah. So, okay, Austin, how do we solve the affordability problem then, right? I mean, to Max's point, insurance is up 20–30%. I know I've gotten a couple surprises with my tax bills and insurance bills. Utilities are going up because of what we're seeing with the demand situation. So, how do you even start? How do you even think about policy in this kind of environment?
Look, I think it's everybody. No one developer, no one builder, no one institution is going to make, a significant impact. It's more of trying to work with local electeds on developing smart policy. It's really just trying to make an impact one by one, day by day. We've seen at this point, there's probably 24 different states that have, various subsidy programs, tax abatement programs. We operate a few thousand units in that space specifically, but it's all been largely, landowners that have had stuff at next to nothing basis and trying to then mobilize our local resources. So it all takes pilots and heavy negotiation of those pilots, and takes a lot of political influence. So it's not an easily scalable business model. There's been some very real positive changes coming out of this administration with One Big Beautiful Bill. You've seen the reduction of the 50% private activity bond test on low-income housing tax credits. Estimates there are probably going to be stimulative at about $1.2 million in terms of new unit delivery, because that's really the marketplace that's suffering the most. Right? It's probably we'd say 35, 40 homes out of every 100 affordable homes for extremely low income earners. That's a really dangerous place to be when, to your point, Max, right, everything is up. What does a gallon of milk cost? What does eggs cost? These are really the people that we aim to serve. But, this is becoming much more of a dissipating middle class issue. And so solving these mixed income development challenges is really going to be probably the most important area of focus. Is
there a region or an area that could serve as a model where you've seen progress in affordability come back in line?
Yeah. So we were involved in a development in Los Angeles. It's a 100% non-subsidized affordable housing project, utilizing a bunch of local resources, welfare tax exemption. ED1 was passed by Mayor Bass, which is effectively ministerial approval of affordable housing. So you get through all of the environmental challenges. That's a very, very difficult state to develop in. And we were very proud, but to the same end, there were probably 16,000 units worth of applications, and only a handful of those projects actually, got through into permitting. We just closed that in 2 months ago. We have a substantial one in Newark, right, which is another one. Again, subsidized heavily by the state. We have through the Aspire program, and that's just a market that is, to touch on a really good point, right? It's desirability, and that's really challenging, right? So when we look around the landscape, trying to figure out which markets are actually oversupplied, but not only, or undersupplied, but also where the rental demand is going to continue to be sustained, because you still have, lease-up risk. You still have all of these other things that are going to drive rent growth to actually make these projects feasible, because you're coming off of, again, these other challenges, which is construction costs, labor shortages, all these things. And so just seeing what's happening with depreciation benefits, the extension of opportunity zone benefits and the permanency of them, so those being delivered in 2026 are going to be a huge tailwind for everybody involved in the housing sector.
Michael, speaking of demographics, when do you think we'll start to see that play out in the larger picture outside of housing? It's going to have an impact at some point if it hasn't already.
Yeah, I mean, it's been kind of a slow burn, I think, for the U.S. so far, but if you're looking out 10, 20, 30 years, that's where you start to see the population peaking and starting to slow down, and certainly working age population at least, but so that gets to the place where people can't afford to wait 20 years for there to be housing supply, though, right? So it's not necessarily a solution to wait it out. I know we were talking about patience earlier in the short term, but talking 20, 30 years is just, when it comes to a need for people, it's not viable. But it is that aging boomer population owning lots of homes and then being the kind of peak population that we have and slowing down from there. Certainly slowing in immigration will be a bit of a more immediate impact, but nowhere near the kind of long-term trend change that we would see with the whole population aging.
Yeah, being impacted. Max, I also think part of it too is when you factor in the rush to be successful during COVID, to your point before, where you're in a hybrid environment and now things are shifting so quickly, right? Then you have to think about childcare costs and school and everything else. There's a lot that goes into this equation that perhaps wasn't at the forefront when making decisions prior to. We knew we were here 5 days a week. We knew what childcare costs and so forth, and we would gripe about it. But then when you have a taste of what it could be like, where it changes your affordability picture, and these things do matter when you have insurance up 20, 30%, utility
100%.
bills. So I think there's just a lot that's coming at consumers right now.
There's a lot of variables and a lot of friction. Like you talked about being in office, when you make plans, okay, I can move out further. It's a little bit more affordable. I get more space. There's childcare out there. And then when you're back in 5 days a week, four or 5 days a week, that calculus changes. There's also just a ton of friction. Just think of the cost of selling your home. And it's not just commission, but closing costs and friction, how long it takes. When you sell your house or you buy, you have that huge stack of papers you're going through signing, getting the title and the deed. There's just a lot of friction, and I think digital assets can play a part in kind of lubing the system a bit to make it easier to transact. It's another thing for the people that are in their homes looking to sell. Wait a second, my closing costs here, it's very costly to get out of the house and then go out and buy another one. So we're moving some of that friction, making it less expensive to be able to. Now, obviously, it's a large purchase, so it's not like trading stocks where it's kind of in and out, but making it easier to facilitate that process, whether it's quicker, cheaper, just making it simpler so somebody can and not have to factor in that additional cost of, okay, renovations, getting a house ready. There's just a lot of costs and variables that go into buying a home, selling a home, where you're moving, and trying to eliminate some of those friction points. I think could help open it up a bit. If you're looking for a house, you have to factor those things in. Commute times, childcare, schools, location is obviously a huge part. And again, when you were working from home, totally remote, you really had that freedom. You could be 6-7 hours, you could be a flight away from an office, didn't really matter. Now that's changing, and it kind of adds to that, the friction of, I really can't go out that far, despite there might be, affordable housing out there. It's just too far. I have to do this daily commute. It's just not going to work anymore. So it kind of just, again, tamps down the potential for you to actually expand out and not be so concentrated and having to build up. Being able to build out would be great, but again, you're not where you need to be in the right, neighborhoods with the right school and everything. So it adds to that friction slowdown. Yeah.
Well, it's interesting. I read an article in the Times a couple months ago, and they were profiling people who had just bought their first home as an example. And I think the expression is house rich, cash poor, because it is shocking.
Yeah.
Like everything that goes into the transaction, as Max had just mentioned. And then, of course, the excitement of it and decorating and all that too. But it really is shocking just how quickly everything comes out of the savings account as well. But there's also that fine balance of, we don't want to get into a situation like we saw in 08 and 09 where everybody's underwater. And then, you don't want interest rates to go down for bad reasons necessarily. So there's the balancing act of that as well.
Yeah.
But then you also had private equity as an example coming in and buying up all these great deals that were out there.
Yep.
So how do you mitigate that?
I think it's interesting because we hear a lot about the Blackstones of the world, the KKRs of the world, and they actually they represent a very small subset of the percentage of single-family homes in America. Build to rent as an asset class has emerged as one of the largest, fastest growing asset classes in commercial real estate, which has been great. They're troubleshooting it every single day. Pulte, head of the FHFA, floated the idea of trying to roll programs in to essentially subsidize mortgages for the national home builders, which would be very, very interesting. I think one of the things that, figures that were floating around was something about 2 million lots, that are zoned and entitled and ready to go. I think the only issue there being is what is the real demand? Because most of these home builders are pretty sophisticated. They've been sitting on these land sites entitled for quite some time. And so, we all work in this business. We know what that future planning looks like, and there's a reason they probably don't want them coming out of the ground so quickly. But the capacity is there. And so the confluence of things like that, Fannie Freddie, about 8 years ago, introduced the low down payment, mortgages for qualified first-time home buyers at like 2-3% on down payments. Those were interesting programs. Things like tweaking credit standards, not so much from subprime credit, but increasing amortization schedules. Maybe it's not 30-year mortgages, maybe it's 45. I think there's got to be ways for those agencies who play the biggest, part of, housing finance as far as single family is concerned to be able to, stem off the problem. But those are a lot of the ideas that are floating around, and it just comes down to Washington to kind of get comfortable. But it's challenging, right? Because, the talks of privatization of Fannie and Freddie could have material consequences that ever actually came to fruition. So a lot of it is just echoes of 08, but it all seems to be, I think, a little murky in terms of being able to really pinpoint what's going to move the needle or where it all will land.
All right, well, we appreciate everyone's insight. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.